the ripple effects of FTX's collapse being felt across the crypto space, the Grayscale Bitcoin Trust trading at a record discount to net asset value this week, nearly 50%. Could GBTC's struggles be another potential negative catalyst for this industry? For more, let's bring in Ram Ahluwalia, the CEO of Lumida Wealth Management. Ron used to be head of crypto and digital assets over at Cross River, so you're very familiar with the space, Ram. First, to the GBTC. It has traded at a discount for a very long time on the premise that that discount would close once GBTC is converted to an ETF. This is a whole other story here when we're talking about a 50% discount. What do you think that signals?
That's right. So there's lack of confidence in the conversion to an ETF, in part because SEC Chair Gensler in November of last year denied the conversion. That's one. Two, there's also concern that DCG, which is one of the largest owners of GBTC, may be forced to sell GBTC into the market because they've got $2 billion in debt owed in part to their subsidiary, Genesis Lending, and other creditors.
So basically, it owes its subsidiary. Its subsidiary loaned it $2 billion.
That's correct. And that's right. That's right. So Genesis Lending was the world's largest crypto prime brokerage. It took in short-term liquid deposits from, say, the Gemini Earn program. Gemini is the exchange started by the Winklevoss. And then it made long-term illiquid loans to hedge funds such as Three Arrows Capital. And Three Arrows Capital blew up. Why? Because they were betting on the discount to close and financing that with leverage from whom? Genesis Lending. Incidentally, DCG, the parent company of Genesis and Grayscale, also bought $780 million worth of GBTC. They're making the same trade, and they also borrowed from their subsidiary, Genesis. They bought an average purchase price of $40. Now it's $8, unrealized loss of 80%.
So can they hedge any of that loss? Some amount is Bitcoin going down, and some amount is the premium obviously moving. Are they short Bitcoin? Is there any way for them to lessen this situation?
DCG's financials are private. They could have attempted to hedge that, but they were betting on the price of Bitcoin going up and the discount closing.
Or maybe even going to a premium.
That's correct. And the premium had been in place since the inception of GBTC from 2017 to 2021, from between 30 to 35%. And that's what started this whole dynamic and the first leg of contagion, the first domino to drop, because it created the perception of arbitrage. You could buy Bitcoin, commit to deliver in 6 months to the Grayscale Trust, and you would capture the premium 6 months later at the time of delivery. So now, fast forward, 2021, peak bull market, billions of dollars getting financed on Bitcoin. Genesis is enabling that, and people are betting on the super cycle thesis for Bitcoin. The discount closes. Why does it close? Because prior to Coinbase, GBTC was the most convenient way to access Bitcoin in your brokerage account. With the Coinbase IPO and other on-ramps coming on, it became easier to access. The spread closed and then widened.
So this all sounds like a terrible game of musical chairs.
Absolutely right.
So what do you think? What do you think happens? You don't have any skin in the game right now, but you have seen a lot of these. You've seen BlockFi's books, right? I mean, you were in a position before at Cross River to be familiar with these companies.
Well, I won't comment on the books, but yes, in my role at Cross River, I built the crypto business. I interacted with BlockFi, Three Arrows Capital, a number of these institutions, and you could see that, of course, they want short-term funding from a bank, but they're really capital markets businesses that are taking depositor money. These deposits are not FDIC insured, but they look like a deposit account with high yield. Right. And they're turning around and lending to hedge funds, but they have a veneer of a neobank. And that's not sustainable. And of course, BlockFi incurred a $100 million fine from the SEC.